All right, welcome everyone to another deep dive. Today we're going to be exploring, I guess, what you might call a niche player in the Indian financial scene.
Right.
It's India Shelter Finance Corporation.
Yeah. I've uh I've heard of these guys. I think their main thing is affordable housing, right?
That's exactly it.
Okay.
They're really focused on those tier 2 and tier 3 cities. Not the big metro areas, but those kind of up and coming smaller cities around India.
Interesting. Interesting. So, what kind of information do we have about them for this deep dive?
Yeah, so we've got a pretty good spread of information here. We've got transcripts from their earnings calls for the last few quarters. So that's Q4 of their financial year 2024, and then Q1 and Q2 of FY25.
Got it. So, like the most recent data we have is from the second quarter of this year.
Exactly, pretty up-to-date stuff. And we've also got their annual report for the last full financial year, FY23-24, and a couple of their investor presentations.
Okay, so a good mix of recent performance data and then also some of their kind of plans and strategies going forward.
Right, yeah, that longer-term view. So for you listening, what we want to do today is really unpack how India Shelter is doing. We're going to look at the key metrics they're tracking, how their business is actually performing. Then we'll dig into what's driving that performance, what are they doing well, where are they seeing success, and of course, we'll also look at how they're thinking about and managing risk.
Yeah, risk is always key in finance, right?
Yeah.
Especially when you're dealing with lending and specific segment of the market like affordable housing.
Absolutely. So think of this deep dive as your shortcut to understanding India Shelter, kind of like a cheat sheet, if you will, without having to go through all those reports yourself.
Love a good cheat sheet.
Yeah.
So should we start with their performance in the last full year, FY24? It looks like they had a pretty decent run from what I saw.
Yeah, they really did. Their assets under management, their AUM, grew by a pretty impressive 40% year on year.
Wow, 40%, that's a pretty significant jump.
Yeah, it is. And they ended the year with a total AUM of over 6,084 crores. So that's basically the total value of all the loans that they've given out.
Okay, so that's a good indicator of just the overall scale of their operations, right? How much they're actually lending out there.
Exactly, yeah. And it seems like this growth is not just coming from opening up more branches. They're actually seeing increasing demand for their loan products in those markets that they're targeting.
Makes sense.
Uh,
I mean, if there's more demand, you'd expect to see that reflected in the total value of loans they're managing, right?
right. And it wasn't just the AUM that was growing. They were also actually giving out a lot more money in new loans.
Okay, yeah, disbursements, right? That's the actual money flowing out the door.
Yep. Their total disbursements for the full year were up 35%.
Another solid number.
Yeah, totaling 2,646 cores. And even if you just look at the last quarter of that year, Q4 FY24, their disbursements grew by another 10% compared to the previous quarter. So they finished the year strong.
Okay, so they're seeing that continued momentum even towards the end of the year.
Right. Yeah. It seems like there's a pretty consistent demand for their loan products. Now, one thing they've also been doing is expanding their branch network quite aggressively.
Yeah, I did notice that. I think they mentioned adding something like 40 new branches throughout the
You
year,
got it.
thing like that.
40 throughout the year and then another 8 in that final quarter.
Wow.
So they now have a total of 223 branches across 15 states.
So that's a pretty clear indication of their commitment to having that physical presence in these
Yeah.
in these tier 2 and tier 3 cities.
Right. Yeah. They're not just relying on online platforms or remote lending. They really want to be there on the ground in these communities.
I guess it makes sense if they're dealing with customers who maybe are first-time home buyers or maybe haven't had a lot of experience with the financial system.
Yeah, that personal touch can be really important. And another thing that stood out to me was that they seem to be very focused on their own teams finding these customers.
Ah, so they're not outsourcing a lot of their sales or customer acquisition, I guess.
Right. Yeah. They reported that 98% of their loan sourcing in FY24 was done internally.
Hmm. That's pretty impressive. I mean, it suggests they're not just focused on growth, but also on the quality of that growth.
Exactly. And, anytime you're lending money, the quality of the loans is absolutely critical. So, how did India Shelter do on that front?
Well, the good news is that they actually showed improvements in their asset quality during FY24.
Okay, that's great to hear.
Yeah. If you look at their DPD 30 plus meet, which is basically the percentage of loans where payments are overdue by at least 30 days.
Right. Kind of an early warning sign for potential problems.
Exactly. That number actually improved significantly, going from 3.5% down to 2.4% year on year.
Okay, so less loans falling behind on payments.
Yeah, that's the takeaway there. And then their growth stage 3 and net stage 3 assets, those also improved, although not by quite as much. These stages are for loans that are further along in the delinquency process, I guess you could say. So those are more serious cases.
Got it. So lower numbers for those are obviously good.
Yeah, definitely. It suggests that they're doing a good job of managing their loan book and keeping those problem loans to a minimum.
And it seems like the credit rating agencies have taken notice of this as well.
Oh yeah, they did get a credit rating upgrade, didn't they?
Yep. India Ratings and Research gave them a rating of AA with a stable outlook.
That's pretty decent rating, especially for a
Yeah.
company that's operating in this kind of more specialized segment of the market.
Right. And it's important because a better credit rating can make it easier and cheaper for them to borrow money themselves, which is obviously crucial for any lender.
Totally. It basically gives them more access to funding and potentially at lower interest rates.
Okay, so improved asset quality, a credit rating upgrade, all signs of a healthy and growing business. But what about the bottom line? What about their profits?
Well, it looks like all this positive development had a pretty direct impact on their profitability.
Okay, good, good.
Yeah, their net income for Q4 FY24 was up by a healthy 40% year on year.
So they're making more money?
Yep, and for the full year, their profit after tax, their P8, surged by 59%, reaching 248 crores.
Wow, that's a big jump in profit.
Yeah, it is. So they're not just growing; they're becoming more profitable
Yeah.
as they grow, which is a good sign.
And what about the profitability of their core lending business? You know, the margins they're making on the loans themselves.
Well, it looks like they've been able to maintain pretty healthy net interest margins.
Okay, good. So that's basically the difference between the interest they earn on their loans and the interest they pay on the money they borrow, right?
That's right, yeah. And they've been keeping their NIMs around that 6% mark.
Okay, so that's a good indicator of a healthy and consistent lending business.
Yeah, and maintaining that margin is crucial, especially in a market that's as competitive as the Indian financial market.
Right. Now, one thing I thought was really interesting is that it seems like they're also becoming more efficient in how they run their operations.
Yeah, their operating leverage looks pretty good. What that means is that their operating expenses, so like the cost of running the business, are growing at a slower rate than both their assets and their income.
Okay, so they're getting more bang for their buck, so to speak.
Exactly. And if you look at their OPEX to AUM ratio, that's like the operating expenses as a percentage of their assets, that came down to 4.4% in Q4 FY24.
Okay, so they're spending less, relatively speaking, to manage those assets?
Yeah, and their cost to income ratio, which measures like how much it costs them to generate each rupee of income, that also improved significantly, down to 38%.
So all signs pointing to them getting more efficient as they grow.
Yep, which is great to see. It means that they're not just throwing money at the problem, they're figuring out how to scale up their business in a smart and sustainable way.
Right. Okay, so far so good. They've had a strong year in FY24. But what are they looking at for the current year, for FY25? What are their plans?
Well, their guidance for FY25 gives us a pretty clear picture of where they're headed. They're planning to add another 40 to 42 branches this year.
So that aggressive expansion is continuing.
Yeah, it really is. They're clearly committed to growing their footprint in these tier 2 and tier 3 cities.
And they're expecting to keep those profit margins up, right?
Yeah. Their goal is to maintain their net interest spread, which is another way of looking at that in it, around 6%.
Okay, so that consistent profitability is still a top priority.
Definitely. Now, when it comes to risk, they've given a credit cost guidance of 40 to 50 basis points for FY25.
So that's basically an estimate of how much they think they'll lose on loans that don't get fully repaid, right?
That's right, yeah. And it's expressed in basis points. So 100 basis points equals 1%.
Okay.
So they're basically saying they expect to set aside somewhere between 0.4% and 0.5% of their total loans to cover potential losses.
Got it. And how much are they planning to grow their loan book this year?
Their loan growth target for FY25 is between 30% and 35%.
So a little bit slower than that 40% AUM growth they had last year, but still a pretty substantial expansion.
Yeah, it's still a healthy growth rate.
Yeah.
And it seems like they're trying to balance that desire for growth with a focus on managing risk and maintaining profitability.
Right. And they're sticking with that focus on those smaller cities and towns.
Absolutely. Tier 2 and Tier 3 cities remain their primary target market, and they see government initiatives like PMA2, the Pradhan Mantri Awas Yojana, which is a scheme that supports affordable housing, as a big driver of demand in those markets.
So they're kind of riding that wave of government support for affordable housing.
Yeah, in a way, and it makes sense,
Ah,
right?
sure.
I mean, there's a huge demand for housing in India, especially in these smaller cities that are experiencing a lot of growth.
Right. And that emphasis on direct in-house sourcing of loans is also still a core part of their strategy.
Yep, they really believe in that. They say it's crucial for maintaining both the yield they earn on their loans and the quality of service they provide to their customers. And it's interesting, they've actually said that they want to maintain that 6% spread even if their own cost of borrowing goes down.
So they might be willing to pass some of those savings on to their customers.
Yeah, that's what it sounds like, which I guess would be a good way to build customer loyalty and stay competitive in the market.
It really seems like they're thinking about the long term, not just about growing as fast as possible, but about growing in a way that's sustainable.
Yeah, I agree. They're not just chasing numbers. They're paying attention to things like branch productivity, making sure that each branch is actually generating a healthy amount of business. They see a target of 17 to 18 monthly disbursements per branch as a good sustainable level.
Okay, so they have those internal benchmarks to make sure that their growth is actually translating into real results on the ground.
Right. It's not just about opening branches. It's about making sure those branches are successful and contributing to the overall growth of the business.
And what about their customers? How long do they typically stay with India Shelter?
Well, they're expecting a pretty long customer life cycle, an average of about 6.5 to 7 years.
Okay, so that's a pretty long relationship.
Yeah, it is. And they say that's especially true for their self-employed customers who take out loans against their property.
Okay, makes sense.
Yeah, I guess those are often loans that are used for business purposes, so there's a bit more of a long-term commitment there.
Let's talk a bit more about the types of loans they're actually offering and who's taking them out.
Sure. So their loan portfolio is fairly diversified. About half of their loans are home loans, and about 42% are loans against property.
Okay, so a pretty even split between those two main types.
Yeah. And the average loan size is around 10 lakhs.
Okay, so that really underscores their focus on that affordable housing segment.
Yeah, it does. They're not really dealing with those big ticket, high-end loans.
And who are these borrowers? What's the typical profile?
Well, a majority of their borrowers, about 71%, are self-employed individuals.
Okay, so that's a key characteristic of their target market.
Yeah. And as we've mentioned, the vast majority of their business is concentrated in those Tier 2 and Tier 3 cities. And a lot of their customers, about 70% in Q1 of FY25, were first-time mortgage borrowers.
So they're really serving a segment of the market that might not have as much access to traditional banking services.
Right. They're filling a gap in the market, which is a good position to be in.
What about their loan against property portfolio? Can you tell us a bit more about that?
Sure. So their LAP portfolio is mostly secured by residential properties that the borrowers themselves occupy.
Okay.
And their loan-to-value ratios, their LTVs for these loans are typically around 45–46%.
Okay, so that's a measure of how much they're lending compared to the value of the property, right?
That's it, yeah. And a lower LTV generally means that the loan is less risky.
So they're not being overly aggressive with how much they're willing to lend?
Right. And they've said that a lot of these LAP loans are used by self-employed individuals to expand their businesses,
Hmm.
which makes sense given the profile of their customer base.
Now, given that they're operating in segments and markets that might be considered, a little bit higher risk, what kind of processes do they have in place to manage that risk?
Well, they seem to have a pretty stringent onboarding process, especially for their loan against property products.
Okay, so they're being careful about who they lend to.
Yeah. They do multiple visits to the customer's premises, both their business and their home, to really get a good understanding of their financial situation.
Yeah.
And they gather a lot of data on each applicant, like 70 to 80 different data points.
Wow.
Yeah, it's a very thorough process. And they also use data science and credit scoring models to help them assess the creditworthiness of potential borrowers.
Okay, so they're combining that traditional, on the ground assessment with some more modern analytical techniques.
Exactly. They're trying to get the best of both worlds.
And what about if a borrower does run into trouble repaying their loan? What kind of recourse do they have?
Well, as a housing finance company, they have certain rights under the SARFAESI Act, which is a law that allows lenders to take steps to recover their assets if a borrower defaults.
Okay, so they have some legal protections there.
Yeah. And importantly for India Shelter, these rights apply even for smaller loan amounts, starting from 1 lakh.
Got it. So they're not just relying on goodwill or hoping that borrowers will do the right thing. They have some actual legal tools they can use if they need to.
Right. And they also do regular checks on their borrowers through credit bureaus to see if they're taking on additional debt elsewhere, which could be a sign of potential financial stress.
Yeah, that makes sense to
Yeah.
kind of keep an eye on things. Now, I know they did mention a slight increase in overdue loans in Q3 of FY25.
Yeah, there was a slight uptick in their 30-plus day delinquencies. They reached 3.7% in that quarter. But they attributed a lot of that to some specific operational changes they were making in one particular region, Madhya Pradesh.
Okay, so not necessarily a systemic issue across the whole portfolio.
That's what it seems like. And they said that the rate of new loans becoming delinquent had stabilized, and they were taking steps to address the situation.
Okay, good. Let's move on now to how India Shelter funds its lending operations. What's their overall funding and liquidity situation like?
Well, they've said that they have a strong and stable pipeline of funding, and that they have access to a variety of cost-effective long-term borrowing options.
Okay, so that's important, right? To have that steady stream of funds coming in.
Absolutely. And they've benefited from those credit rating upgrades we talked about earlier.
Yeah.
Those have definitely made it easier for them to access funds and potentially get better terms from lenders.
Right, yeah. A good credit rating can really open doors. And what about their cost of borrowing? Are they seeing any trends there?
Yeah, they're expecting their cost of funds to decrease by about 15 to 20 basis points by the end of FY25.
Okay, so that's good news for them. It means they're paying less to borrow money.
Right. And a lot of that is due to that recent credit rating upgrade to AA that makes them a less risky borrower in the eyes of lenders.
And that, of course, flows through to their profitability. Now, what about the National Housing Bank, the NHB? How big a role does the NHB play in their funding?
The NHB is a significant partner for them. About 15% of their funding comes from the NHB.
Okay.
And they use both the NHB's regular refinance schemes and the ones that are specifically designed for affordable housing.
So they're taking advantage of those specialized programs that are out there to support this sector.
Yeah, exactly. And they've said that the margins they earn on loans that are refinanced through the NHB are generally pretty similar, whether it's a regular scheme or an affordable housing scheme.
Okay, so it doesn't really make a big difference to their bottom line which one they use.
Right. Now, it also looks like they're maintaining a pretty healthy buffer of liquid assets.
Yeah, that's important, right? To have that cushion in case things get a little tight.
Definitely. As of the end of June 2024, they had a liquidity buffer of 193 crores. And their liquidity coverage ratio, their LCR, which is a measure of their ability to meet their short-term obligations, was very strong at 207.83% at the end of March 2024.
Okay, so well above the regulatory requirements.
Yeah, they were in a good position liquidity-wise.
And what was their actual cost of borrowing in the most recent quarter?
Their average cost of funds in Q1 of FY25 was 8.8%,
Okay.
which is competitive. But they have said that they want to reduce the gap between their borrowing costs and those of some of their peers.
So they're still looking for ways to improve on that front.
Yeah, always looking for an edge.
Okay. Let's go back to their branch expansion strategy for a moment. What does a typical team at a new branch look like?
Well, when they open a new branch, they usually start with a branch manager, 3 to 4 loan officers who are responsible for bringing in new business, a credit manager to handle loan approvals, and then someone to manage operations and customer service.
Okay, so a pretty lean team to start with.
Yeah. And then as the branch grows, they add more staff, especially in areas like business development and collections.
Makes sense. And how long does it usually take for a new branch to break even, to start making a profit?
They're typically looking at a break-even period of about 8 to 9 months.
Okay, so not too long.
No, it's a pretty quick turnaround. The average annual operating expenses for a branch are about 25 lakhs, but that can vary depending on the location and things like rent.
Right. And do they have different expectations for branches in different stages of maturity?
Yeah, they do. In their first year, new branches are expected to disburse about 75-80 lakhs in loans each month. Then, after a few years, that figure usually goes up to around 1 Rio per month. And then for more mature branches, those that have been operating for more than 3 years, they're often doing over 1.2 crores in disbursements each month.
Okay. So they have those kind of benchmarks to track how branches are performing at different stages of their life cycle.
Exactly. And they also pay close attention to the number of actual loan units disbursed, not just the total value of the loans. They want to see at least 10 units dispersed per month from an average branch.
Okay, so it's not just about the big loans, it's about getting those smaller loans out there as well.
Right. And once a branch reaches a certain level of productivity, they start looking at opening a new branch in a nearby area.
So it's a very deliberate, geographically focused expansion strategy.
Yeah, it is. They're really sticking to that contiguous growth model, building out their presence in those 15 states where they already operate.
Okay. We've talked a lot about FY24. What were some of the key highlights from the first quarter of the current year, FY25?
Well, Q1 of FY25 showed that they were continuing on that positive trajectory. Their net income grew by 54% year on year, reaching euro 184 crores.
Wow, so it's still growing strong.
Yeah. Their efficiency ratios also continued to improve. Their OPEX to AUM ratio was down to 4.4%, and their cost to income ratio was down to 37.8%. And on the asset quality front, their gross stage 3 and net stage 3 ratios remain stable.
Okay, so all the key indicators are moving in the right direction. Now, what about co-lending? Are they doing much of that?
Yeah, they're doing some co-lending, but it's mostly focused on their loan against property products.
Okay.
Their home loans are still entirely on their own balance sheet. Co-lending currently accounts for about 6% of their total disbursements.
Okay, so it's not a huge part of their business at this point.
Right, but they have said that those co-lending arrangements tend to be a little bit more profitable, so they're still evaluating whether it's something they want to expand.
Makes sense. There's been a lot of talk in the industry about fixed versus floating rate loans, especially with the possibility of interest rate changes in the future. What's India Shelter's mix looking like?
Right now, about 50% of their loan book is fixed rate.
Okay, so half and half.
Yeah, but they're planning to bring that down to about 40% over the next 12 months.
Okay, so shifting a bit more towards floating rate loans.
Yeah, and they've already started doing that with their LAP portfolio.
Makes sense. If rates do go down, having more floating rate loans could benefit them.
Exactly, because the interest income on those loans would adjust downwards, but their own borrowing costs would likely go down even faster, so their margins would expand.
Okay, yeah, I see the logic there. Now, there's also been a lot of concern lately about unsecured lending in certain parts of the market. Is that having any impact on India Shelter?
Well, they've said that they don't think so.
Okay, interesting.
They believe that the affordable housing market, especially the segment that they're targeting, operates quite independently from the unsecured lending market.
Okay, so they see it as kind of a different animal.
Yeah. And their customers tend to have lower loan-to-value ratios, so they have more skin in the game. So they're not seeing any decrease in demand for their products, and they're not overly concerned about those broader trends in the unsecured lending market.
Okay, that's good to hear. Finally, India Shelter recently went public, right? What can you tell us about their corporate governance and their social responsibility efforts?
Yeah, they listed on the NSE and BSE in December 2023,
Okay.
and they've emphasized their commitment to good corporate governance. They have independent directors leading key board committees like the Audit Committee and the Risk Management Committee.
So they're taking those responsibilities seriously.
Yeah, and they're also involved in a number of CSR initiatives through trusts like the Bansi Vidya Memorial Trust, which focuses on healthcare, and India Shelter Nai Umid, which works towards women's empowerment.
Okay, so they're giving back to the community.
Yep, and they're also big on employee training and development, so they're really trying to hit all those ESG targets.
Yeah, it seems like they're trying to build a well-rounded and responsible business.
That's the impression I get as well.
Okay, so to wrap things up, what are the key takeaways from our deep dive into India Shelter Finance Corporation?
Well, I think the main takeaway is that India Shelter is a company that's really found its niche in the affordable housing sector, especially in those Tier 2 and Tier 3 cities. They're growing rapidly, and they're doing it in a way that seems both profitable and sustainable.
Yeah, I agree. They're clearly focused on serving a specific segment of the market, and they've developed a business model that seems to be working well for them.
Right. They're focused on in-house sourcing, their branch expansion strategy, and their careful risk management approach all seem to be contributing to their success.
And they're clearly committed to those smaller cities and towns. They see the potential there, and they're putting their money where their mouth is.
Yeah, absolutely. And they're also benefiting from government initiatives that are supporting the affordable housing sector. So they're kind of riding that wave as well.
Right. Now, here's a final thought for you to ponder. Given India Shelter's focus on those first-time home buyers in smaller cities and their reliance on their branch network for customer acquisition, how do you think the growth of digital financial services and the increasing internet penetration in those very regions is going to impact them in the years to come?
That's a really interesting question. I mean, they've clearly been successful with that brick and mortar approach, that personal touch. But the world is changing, right? More and more people are accessing financial services online.
Exactly. So it'll be fascinating to see how they adapt and how they incorporate those digital trends into their business model going forward. Thanks for joining us for this deep dive,
My pleasure.
and we'll catch you next time.